Good afternoon, ladies and gentlemen. Thank you for standing by, and welcome to Fawaz Al Hokair's Q1 full year 2023 earnings call. We have circulated today's presentation already, but in case you have not received a copy, please feel free to visit our IR microsite, ir@fahrretail.com, where you'll find all the disclosure materials. To shed more light on the financial results and operating developments, I'm joined today by Mr. Ahmed Belbasi, our CFO. As usual, the presentation will be followed by a question and answer session. I'll now give the line to Mr. Ahmed. Please go ahead, sir.
Thank you, Michael, and thank everyone for joining the earnings call today. So we reported a good set of results with all the operating segments showing stability and resilience despite some ongoing inflationary pressures, supply chain hiccups, and higher interest rates. So our profitability was further supported by the ongoing measures to streamline our operation, rationalize our cost, and actively manage our inventory as well. Those efforts have been continued to reinforce our position as the leading lifestyle retailer in Kingdom and the partner of choice in strategic markets, building on the foundation laid in the prior years through the optimization of our portfolio and enhancement of our omni-channel capabilities. Particularly, the food and beverage segment delivered a solid performance as the initial income stream from the Subway sub-franchise royalty fees started to come in during Q1. The CIS countries in Jordan had great performance in our well-diversified international portfolio as well, which spans across 10 countries. We continue to explore collaboration opportunities with leading global brands in select growth markets to enhance our portfolio and deliver sustainable long-term growth. I'm very comfortable to say that probably in the coming few months, we announce some more expansion of brands in CIS countries. If you look at the current chart, we have maintained a stable, well-diversified brand portfolio so far, which again is a key pillar to our strategy. Our offerings cover the majority of segments that our brands base of consumers typically look for. Our brand mix is evolving to move toward a more lifestyle portfolio and a higher margin segments, which will further preserve our competitive positioning in the market. This is really anchored by the solid relationships that we are maintaining with our partners who present some of the leading global brands. The aim is to achieve an improvement in margins and profitability while continuing to launch new and innovative concepts to the dynamic Saudi market, as well as select the growth market overseas. For food and beverage particularly, we will continue to enhance segments performance by expanding our footprint in the Kingdom, while also migrating some of the brands to select markets like Egypt and some of the CIS countries in support of the segment's performance in the full year 23 and beyond. If we take a closer look at the retail and the food and beverage landscape. So in the retail, locations for Fnac Darty have been identified. We're planning to open in the coming few months, probably in the coming 3 to 6 months. It's worth noting that we have now returned to a net store opening pattern as the bulk of the network reshaping process has been completed. In the food and beverage, the onboarding of the Subway brand resulted in the first income stream coming from the sub-franchise royalty fee during the quarter, and we are progressing well in our plans to acquire 45 stores of the existing sub-franchise, with the acquisition of 30 of those stores expected to be finalized by the end of quarter 3, full year 23. Omni-channel, our strategic investment in Voga Closet almost 18 months ago has enabled us to introduce some really new and unique brands online to address growing customer demand for a future omni-channel experience. During quarter 1, we successfully integrated more brands on the Voga Closet platform, bringing to a total of 48 brands are currently selling on the platform, which we have stock on hand around 130,000 units. We have also continued to closely collaborate with our brand partners to expand growth overseas. So during Q1, we launched 2 new mono-brand sites in Georgia, Armenia, for Bershka, with a total number of mono-brand sites in international markets up to 7 so far. We will now discuss the financial performance, please. Right. So, top line. So we achieved a fairly stable top line performance during the quarter, 1.7 billion, considering that the higher sales, considering that the higher sales during the Ramadan ramp-up period was fully captured in quarter 4. If we were to adjust the first quarter of the prior financial year to exclude the impact of increased sales during the pre-Ramadan period, consolidated revenue would show a 3.4% year-on-year growth. I'm sure all of you know that there is almost 11 to 12 days shift in Ramadan timing. This year, the ramp-up period, which is the pre-Ramadan, was fully in quarter four. As mentioned earlier, both international retail and food and beverage revenues showed very solid improvement during the quarter, increasing 22% and 8% year-on-year, respectively, while ongoing cost optimization initiative, which resulted in a 9% year-on-year decline in SG&A expenses. Overall, we saw a pleasing 26% improvement in profitability, with net profit reaching 58 million. So we started the new fiscal year on a strong footing, and are pleased by the performance during the holy month of Ramadan, which is one of the best sales seasons. So the total revenue increased 5% year-on-year when looking at the trading period comprising the 30 days of Ramadan plus the 7 days around Eid al-Fitr. Saudi retail sales remained stable during the period, showing healthy growth of 4%, while the food and beverage segment saw revenue growth exceeding 25% year-on-year, with lower pandemic-related restrictions, of course, and pickup in activity. However, without considering those factors, our revenues remained steady on Q1 full year 22 due to the absence of the Ramadan ramp-up period, as previously mentioned. So this also affected Saudi retail revenue, our largest segment, which declined 4% year-on-year to 1.3 billion. Adjusting for the effect would result in KSA revenue remaining unchanged from the similar quarter for last year. Our international portfolio generated revenue of 267 million, which is up 22% year-on-year, which was driven by the sustainable positive momentum from CIS countries and Jordan, despite weaker sales from Egypt due to the Egyptian Central Bank's restrictions that restrained retail companies from importing required inventory during Q1. As for the food and beverage, revenues increased 8% year-on-year, 160 million. However, sequentially, food and beverage revenues declined 11% due to seasonality, given that demand for fast food typically decreases during the holy month of Ramadan. As we approached the later part of the quarter, sales activity started picking up in the anticipation of Eid al-Adha, which started on 8th of July. Consolidated revenues increased nearly 19% year-on-year for the Eid al-Adha trading period, which is defined as the 14 days prior to the start of Eid. In like-for-like terms, consolidated revenue reported 12% year-on-year increase. For the coming quarter, we remain cautiously optimistic as we trade sort of a soft operating environment in KSA, with a lot of people going on vacations and leaving the country during summertime. If you move forward to take a closer look at the profit and EBITDA. So, a closer look at the profit and the EBITDA. So the gross profit amounted to 278 million in Q1, representing a decline of 16% year-on-year as a result of the change in the start of the discount period, which was brought forward 10 days this quarter. Excuse me. In addition to a reduction in trading margins and the flat top-line performance, gross profit margin reached 16% compared to 20% in Q1 full year. EBITDA pre-IFRS 16 declined 3% year-on-year to 146 million, with EBITDA margins of 8.6%, replacing management guidance of 8%. The decrease in EBITDA was primarily due to the impact of the flat revenue performance and reduced trading margins outpacing the reduction of SG&A expenses. We maintained our drive for cost optimization and operational efficiencies, which should contain SG&A expenses in the future, including the launch of the shared service center, overhaul over our digital infrastructure, and the comprehensive analysis of several operational costs. Inventory balances so far reach 1.4 billion, making a decline of 17% year to date after the hike in Q4, as we had initiated an inventory build-up at that time in preparation for Ramadan season, Eid al-Adha, Eid al-Fitr as well. Looking ahead, we are planning to further enhance our retail merchandise planning process, which would help achieve additional supply chain efficiencies and reduce terminal stock. So far as we speak, this inventory has been reduced further to pre-Ramadan levels, I would say that. Our capital restructuring remains the high priority. Our shareholders voted on 29 in favor of reducing the capital by 45%. This already has been implemented. The next phase for the restructuring process is the capital increase, which is we're still in the discussion with the CMA, back and forth communication. Final file has been submitted a couple of weeks ago. We are hopeful that in the near future, I would say in a few weeks, we're hopeful that we can get an approval and take it from there. In summary, so Al Hokair achieved a steady performance in Q1 with the improvement in profitability as our teams continued to make really good progress across the board. The performance was also supported by the holy month of Ramadan, which is an important trading period for us, while cost rationalization and optimization initiatives will still enable further saving. Although conditions in the Saudi market appear to be softening, we expect our international portfolio and food and beverage segment to remain key contributors. We are looking further to expand their contributions in the longer term by exploring new and emerging opportunities for collaboration with leading global brands. The continued successful delivery of our operational upgrade strategy is producing good results, and the continued enhancement of our digital infrastructure and offerings are paying off with a sales level in line with our targets. With our recapitalization on track, we believe that the base we are putting in place is set to deliver sustainable long-term value to shareholders. By this, we're done with our presentation today, and we'll hand it over back to the team to open for Q&As.
Thank you very much for the presentation. We'll now be moving to the Q&A part of the call. If you are dialed in by the telephone, please press star 2 on your keypad, star 2 for the keypad for any voice questions. If you are dialed in via the web, you may also ask a voice or a text question. And I'm acknowledging 1 or 2 text questions that have already came in. Thank you. Our first voice question comes from Mr. Ashar Salim from Yaqeen Capital. Please go ahead. Your line is open.
Hi, am I audible?
Yes, please go ahead.
Okay, this is Ashar Salim from Yaqeen Capital. Thanks a lot for the call, and congratulations on the great set of results. I have a couple of questions. First of all is the F&B and its share in your total revenue. So you've seen that has declined compared to the last year. So any specific reasons why F&B is a smaller portion in this quarter compared to the last year? That's one. Secondly, I believe there has been some changes in the depreciation policy by the firm. Please correct me if I'm wrong, and if you can just shed some light on what exactly is the change and when was this in effect. The last question that I have is regarding the guidance for EBITDA margins for the next 12 months. Are we looking again at 8.5-9%, or we might expect some improvement coming in from there? Thank you.
Thank you, Ashar. So first question, yes, if you look at it, there's a bit of a drop because of seasonality in terms of total share. So the revenues of food and beverage increased, double-digit increase compared to the same period last year. But in terms of the weight or the percentage contribution, it's less because of the impact of the Ramadan season. So usually during Ramadan season, it's and particularly Eid season, it gets very slow in the food and beverage sector. But as a portfolio, it's actually improving in terms of I would say the offline and also the aggregate. You will start seeing some the impact of the expansion in Cinnabon and the stream of the sub-franchise in the coming quarters as well. That's for the question number 1. Number 2, for the question for the depreciation. Depreciation, yes. What happened is last year, actually, I believe, if I'm not mistaken, quarter 2 or 3 last year, we unified and streamlined all depreciation policy across the company. So some of the, I would say, line items of assets were depreciated of different periods. So we unified the policy. And that was, I think, quarter 2 or quarter 3 last year, if I'm not mistaken. So now we have a certain unified policy across all the countries, with exactly like when you buy a machine, is it 5 years or 7 years, and so on and so forth. For the EBITDA guidance, we're cautiously optimistic, but I would say we're comfortable up to 8 to 9%. But I would say that we're hoping that this can be improved as well. As a guidance or as a commitment, I would say 8.5 to 9% is a realistic number for this year.
Okay, thank you very much. Reminder, star two for any questions. We have a voice question coming from Padmagaskar from Aranka. There are two questions here. First one is, what are the steps taken to mitigate the Egyptian central bank's restrictions? Number two, can we expect the similar depreciation expenses in the coming quarters?
I will answer the second one. The easier, yes, the same depreciation in the coming quarters. It should only increase marginally with the new investment in capex. What are measures taken? So far, there are some restrictions. There are a couple of points impacting the operation in Egypt. Number one is importing. So we actually have a discussion. We had a separate discussion with the government in terms of what can be done to ease the import of goods, considering that movement of funds can be from outside Egypt, because the main concern of the central bank is the movement of funds or foreign currency. So we have a discussion around that. I'm hoping that it can be a positive, allowing import with a commitment that I would say settlement be done from outside Egypt. That's from one front. From the second front, we're sitting on I would say, very healthy cash because of the restrictions of, I would say, transferring foreign currency outside the country. And we're going to use this cash actually for expansion. So we're exploring new stores, we're exploring new brands, and as we mentioned, we're quite, I would say, in advanced phase of expansion in the food and beverage. We don't have any brand in our portfolio in Egypt. So we're going to try to use the situation positively by using the funds or the cash available in the country to expand and expedite the expansion in the food and beverage.
Okay, thank you very much. Just once again, a reminder, star two for any additional questions, star two. If you are dialed in via the web, you may also ask a voice or a text question. We'll give another few moments or so for any final questions. Okay, it looks like we have a follow-up question from Ashar Salim from Yaqeen Capital. Please go ahead, sir.
Yeah. I just wanted to, get some color on the expansion plans that you have now. I mean, I believe last 2 years we were in a net closure position, and now we are finally entering the net addition. Do you think is this the best time to, open up more stores with the inflation at such levels, which is still going to take some time to get out of the system? I mean, are you going to expand and, grow at any cost by discounting massively? I mean, how are we going to approach this kind of expansion in the next 12 months?
Actually, it's a very good question. So, yes, we are expanding growth. We are in the growth mode, and that's in a couple of fronts. Organically, through enhancing the experience of our stores, having more goods available, getting into an omni-channel. So it's really sort of the basic fundamental retail excellence that will help to grow the current portfolio, 1,000 store in Saudi Arabia, to grow, I would say, organically. In terms of growth of opening new stores, I'm not going to say that we're cautious, but I'm saying that we're picky in terms of what we choose, in the sense of we're making sure that any expansion as a store, the same brands or new brands, are very, very well studied. And to be honest with you, the quarter one, yes, we opened stores. We were planning to open more stores, but we were very careful, watching the interest rates, watching the inflation trends happening in Saudi Arabia and other countries as well. However, how we're going to tackle this, we're going to be very, very, I would say, skeptic in the business model we choose, whether it's a new brand or whether it's existing brands growth. On the other side, there's a lot expansion of a lot of GLAs or a lot of spaces in Saudi Arabia. So we're just monitoring this period, which is the current couple of months. We have seen it a little bit slow. I would say all the retailers, with finally people leaving the country and traveling. So we're just monitoring for a couple of months to see how the situation is going on in terms of trading. But we're definitely going to be aggressive in the opening, but I would say a selective, I would say skeptic approach, not just opening stores and that's it.
Perfect. Is there, in terms of expansion, are we expecting any more geographical expansion into some new countries which you don't have exposure to as of now, or we are still going to be status quo when it comes to geographic expansion?
Look, the geographic expansion, uh, actually, we are in discussion with a couple of new geographic expansion in CIS countries. This is, again, part of the strategy is to make sure that there is no adventures. So we're going to sort of use our winning horse, which is Inditex brand. So yes, there are a couple of discussions going on now. Uh, However, we really want to be very focused, I would say that. So there is still a big opportunity in Saudi. There's a big opportunity in CIS and Egypt particularly, again, with the easing of the restrictions in Egypt to give us more clarity. So in terms of priorities, I would say grow the portfolio in KSA, expand in the food and beverage, grow the portfolio in CIS and international countries, and then explore other geographies as well.
Perfect. Thank you so much.
You're welcome.
Thank you very much. It looks like we have no further questions at this point. I'll pass the line. Oh, sorry. We do have a question indeed. We have a question from Mustafa Amr from Arayan Investments. Please go ahead, sir.
Hi, this is Akbar from RAN Investment. Just wanted to ask, in terms of the costs that you're facing, whether it's transport, logistics, or any other, could you just talk about the cost pressures and where the greatest pain points are on that? Thank you.
Sure. In terms of logistics costs, I'll tell you, half the problem is solved because uh, half the business is Inditex, where they actually deliver to the up to the point of the sales, which is the port over here. So that's we did not really have an issue there. The other half percent of the 50% of the business, yes, we have seen, of course, spikes in logistics lately, of course, with what's happening in East Europe. We have seen also a bit of delays in deliveries. Uh, it- But I think, honestly, I think the overall system, uh, logistic and supply chain system, sort of after the pandemic, um, knows how to deal with the crisis. I would say that. So I have seen for a few weeks, I have seen some delays and spikes in rates. However, it's not impacting our operation massively. I can say that I would say some marginal impact. How we're going to manage the cost moving forward, we're just an operators. We transfer the cost to the consumer. We're not going to, I mean, it can either be shared between the brand and the consumer, uh, but we operate, we're a franchise operator, you know what I mean? So if there is any, I would say, hikes or spikes in cost, I would say that it's going to be passed to the customer, which we already have done that twice so far in the last 18 months.
Thank you. And that was my next question is, so far this year and specifically in this quarter as well, how uh, have there been price increases and how large have the price increases been?
Yes, we touched price in the last quarter, early this quarter, and it has been basically it's to offset some back-to-back agreements with the brands. Uh, the impact on us as a gross margin should be marginal, and it has been passed to the customer already. So I guess because of inflation expectation, customers or consumers are sort of accepting of or expecting price increase. And let me remind you, our ticket, it's I mean the ticket price is not more than I would say 700 to 800 Saudi riyals. So when you say 5% increase, it's not really something it's not an electronics where we're going to 5% can be equivalent to 1,000 riyal or more. So yeah, we haven't seen, I would say, uh, a big impact in terms of the demand. On the contrary, one of our brands where we decreased prices, Decathlon, we did not see demand was not really elastic, so we decided to pump the prices up again, which is and again it did not affect the sales that much. So yes, we're looking into that. The price sensitivity, I would say that we're taking it carefully, but we haven't seen sort of a big impact. The one thing to be careful when we do this is the price comparison in the original country. So when you buy an Inditex brand here, there's around 30% more than Europe. And of course, now with the access to online and shipment and stuff like that, we need to be careful that there is a markup. There's a certain limit on markup when you increase prices. That's the only thing to be considered when it comes to visiting our pricing strategy.
So thank you. That's very helpful. So the 5% growth that you've seen in this quarter, is it really just reflecting the higher prices?
No, it's volume. It's more volume.
So what would be the split between that 5% of volumes and prices?
Look, the impact of the prices is minimal because that was used to offset some, I would say, trading agreements with brands. So cost on us has increased as well. So it was not all going to margin. I would say that, but I would say the majority of the 5%, it's 70% of that is basically volume. Because not all the brands, we did not do this across all brands.
Right. And thank you. And in terms of the portfolio, are you seeing? You mentioned the price, the relative lack of price sensitivity in just now for one of the brands, but of the higher, the higher priced brands, whichever categories they're in, are you seeing sort of down trading, or are you seeing greater resilience? What are you seeing across the portfolio as to where the strength and weakness is coming from?
Look, we did not increase prices for all brands. Again, we're very careful to make sure that there is an incentive or a motive to the consumer to buy from here and not to go and buy it online. Right? So we're very careful about that. So we did not. Our pricing strategy is not really, I would say, category-wise. It's really to make sure that the price point is not at risk. In the sense of, let me elaborate more. So when it comes to, I would say, brands that we are considered value brands. So value brands, you don't have really a margin. You don't have really a margin of increase much because of competition. So it's some of the other brands. I would say that the quality brands, you can still have the price 7 and 8%. So it's really different from a brand to another. It's not just about the higher price brands or the lower price brands, but factors to consider. To summarize that, factors to consider: the price point of the particular type of the brand. That's number one. Number two, the markup from the original country.
Sorry, my question was: are you seeing within your portfolio, regardless of whether you've increased prices or not? I was just trying to understand, given that the Saudi consumer is dealing with inflation and higher prices everywhere, and is in some ways is finding life a little bit harder. Are you therefore seeing that there is less appetite for your more premium brands and more appetite for the value brands?
To be honest with you, I don't have the answer for that yet. We're studying and we're working, we're analyzing the performance in a bit of more detail in the last 3 months or 4 months, but we did not get a result of that. I would say next quarter we'll probably have some answer to that question. It's a very important one. Yeah.
Thank you very much. I appreciate your time.
You're welcome.
Thank you very much. There's a follow-up question that came in via the text from Padmasar from Aranka. What is the reason behind bringing forward the discount period by 10 days to accommodate Q1? Are there any promotional campaigns planned for Q2 or beyond?
Well, it's a purely operational decision. We see how the market is going and we react accordingly. And that's, I would say, the most important, I would say, aspect of managing a retail business. The reason it's first of all, the Hijri days move. That's number one. Number two, we were anticipating that people will be traveling this year, which has actually happened. You can see in the malls the traffic is a bit slower than last year. So we wanted to make sure that we capture the sales period and we do not sit on and increase inventory before we get into summer. That was the only reason that we moved the sales period a little bit.
Okay, thank you very much. It looks like we have no further questions at this point. I'll pass the line back to Mr. Ahmed for his concluding remarks.
Well, again, thank you everyone for your interest and for being present in the call. And I would say that the company is on the right track. Our performance is sustainable. Our strategy is moving from the firefighting strategy or continuous, I would say, fixing of legacy issue into a more of a sustainable growth strategy. We're very confident about the performance so far in quarter one, and quarter two is not different. We're very hopeful, I would say, realistically hopeful that we're going to close the year on the guidance of 8 to 9% of EBITDA margins. We're also sort of working on the strategy with the change of management that happened lately. I would say we are more geared into a growth strategy even further. So again, we're quite happy to be here today. We're confident about the performance so far. Still some ways to go. We're very thankful to all the interest in the company and the support we got from either shareholders, analysts, or investors. And we're always here. We're always available to take your call, whether on a one-on-one. Feel free to basically email us, get in touch with us, and see you next quarter, I guess.
Thank you very much. This concludes today's conference call. We'll now be closing all the lines. Goodbye.
Bye. Thank you.